Guys, please start calling out your friends. We'll begin shortly.
Excuse me.
Yeah,
I wanted to ask that yesterday I missed some last part of day two, so can I continue from today?
yeah.
Yes.
It's totally fine. It's fundamental analysis that is like totally separate. Like
Okay.
Yes, Akash, we are starting soon. Okay, let's start with the session. Hello everyone. My name is Shri Krishna, Associate Quant Researcher at Quant IIT Kharagpur, along with Ramashish Gupta, Associate Quant Researcher at Quant IIT Kharagpur. We are gonna present fundamental analysis of stock market in front of you on the day 3 of Quant Foundations. So we'll talk about first we will talk about the fundamental analysis introduction, like what is fundamental analysis and what is the purpose and what's basically the underlying of fundamental analysis. Uh, then we will talk about the approach of the fundamental analysis, like what kind of approaches we use for fundamental analysis. Like it's a very big category anyway, but we'll talk about them. It's EIC analysis, and it's basically economy, industry, company analysis, and we'll talk about them. We'll talk about lot of factors that we consider in all three analysis types. Then we'll talk about the annual report of a company, what is annual report, and why they why they why they post it on like uh, NSE or their own website, and what is the purpose of the annual report and what is content in the annual report. We'll talk about that. It comes under the company analysis only. Then we will talk about the financial statements, that are financial statements or basically balance sheet and profit and loss statement and cash flow statement. So basically these are the content, like quantitative performance of the company throughout year or their throughout age of their company. We'll talk about them, and then we'll have some discussion around the ratio analysis and the other quantities, which are other numerical figures, such as if you to give example, then P ratio and ROI, etc. Then we'll talk about the F score, that is fundamental score, which tells us about the overall performance of the company. Okay, let's start with the introduction of the fundamental analysis. So basically, like uh, the when we are analyzing a fundamental analysis, the stock market in the stock market price of the stock is fluctuating, right? But there should be some real value which is derived from large number of factors such as quantitative factors, qualitative factors of that company. Such as if to talk about the qualitative factors, then we can come up with the ethics of the companies or future plans. We can assume some values using these qualitative factors, like means we can come up with some numerical figure for the qualitative factors, and for quantitative factors we already have some numerical figures, right? So using all these factors we'll come up with some intrinsic value. So what is intrinsic value? Intrinsic value is basically some real value of that, considering all the assets of that company, and then that we'll compare that intrinsic value with the market price. Okay. So like why are we comparing? So say the intrinsic value of one share of a company is 50 rupees suppose, and the current market price is 45 rupees. So you're getting something which costs 50 rupees at 45 rupees, right? So that's basically overpriced. So basically what will happen eventually, that the intrinsic value and market price will try to coincide with each other. So in this case, stock market current market price should decrease, and its intrinsic value will be remains constant, or can change depending on those factors. So, but it will try to coincide, and so according to that, we put the orders in the market. So basically, in this case, it was overpriced. So we'll just short it, or suppose it's underpriced sometime. That intrinsic value is, higher than its market price. Then we will buy that security. That's how about the fundamental analysis. Okay. So approach to fundamental analysis. So as we talked about it earlier, in fundamental analysis, we consider a lot of factors that come from, vary from upper level to the company level, such as we consider what is the economy of the country it is operating in, or we also uh, consider the factors like what is the environment for that environment for the business in that country. Or we also compare some peers to peers competition comparison. We do peers to peers comparison to find out the best company in that sector in that country, or we do a lot of stuff, and like then we come up with the company analysis. After like first, suppose we talked about the economy of country, then we talk about the industry analysis and all, and then we talk about the company analysis. In company analysis, all that same factors that I talked about, that what is the management ethics and financial statements, and like what are their earnings, profit, ROI, growth, etc. All kind of things we talk about that in company analysis. So like there are some terms here, so you can see like GDP of country. We'll talk about like what is GDP. You must know it's just a gross domestic product, but it is also having some formula and like how they calculate and on what basis. So we'll talk about that. Then that CPI, that Consumer Purchasing Index, that basically is also you know that also CPI is basically used to calculate the inflation or take the measurement of inflation in that company in that country. We'll talk about that. Yeah, we'll take the doubts later. Means just after this slide or next slide. Uh, but then we talk about employment, stock market, interest rates, etc. Then in industry analysis, we compare with the different sectors with the help of possible subsidiaries of the sector, such as like future demand and supply prospects. So basically, if suppose you have come up with some country that you want to invest in. Now you want to see uh, which industries are favored by that country's environment. Like suppose you have come up with India, then you want to see which industries they are good for. So then we are about talk about company analysis. We'll say about them. Then what are the indicators that we use in this economic industry and company analysis? So while doing economic analysis, so okay, so one more point. So like we talked about from economy, then industry, then company. At the same point, we also can first analyze the company analysis, then we can do industry analysis and the economic analysis. So the prior one is called as top-down approach, and the later one is called as bottom approach. In bottom approach, like how you can come up with that. Suppose you are watching news and like you are watching that some company has posted its quarterly reports, and like prima facie you are saying that yeah, that's like good and the company is worth studying about. Then you read about its annual report, then you will see like what are their rivals and how it's performing in amongst their rivals, etc. And then you also see like what countries they are operating in and what are the like what are the economy and like what are economy factors in that countries and that kind of things. So it's also possible that we can start with the company and then we come to industry and then come to economic analysis. So what are these indicators that like we work upon while doing this EIC analysis? So let's talk about the economic indicators. That is first is GDP. So basically GDP is consumers like most of it, it's 70% uh, is contribution from the consumers spending. Okay, it shows the standard of living of the people that are living in that country. So it's C plus. Then talk about the business investments. Then we also talk about the government spending, like government is spending some money on their policies or new projects. Then it comes into that. Then also the whatever goods we are exporting out of the country, and it also considers uh, import of the country. Like what are we importing this goods from other countries? That was say. So its overall formula is C plus business investments I plus government spending plus G minus plus exports EX minus imports IMP, whatever you can say. So that is GDP, and at the same time PMI is basically purchase managers index, purchasing managers index. So it's an alternative for GDP. You can say it's not that much famous at GDP, but it's actually in some countries they consider PMI to be better than GDP because they like they release the PMI on the monthly basis, and also it talks about the uh, business investment part more clearly. That's why PMI is sometimes preferred over the GDP. And there's next CPI. CPI is Consumer Purchasing Index, as I told you earlier. So let's see what is CPI. Suppose like you have taken one basket, okay? You have taken one basket of all the goods, okay, in the country, and like one quantity of each of the goods the country is producing. Like today's the date, 29 May 2022, and after the 1 year we are calculating the price, the cost of all that basket. So it's basically price after 1 year divided by price today into 100. That's what about CPI. It also tells about the inflation of the country. Okay, so like why, and one more point in GDP and PMI. So basically what happens is like there are like also two types of GDP. The one is the like normal GDP and the other one is real GDP. So what happens is in real GDP, they adjust that GDP with the inflation. Okay. So if you adjust the both GDP and PMI, they have really good correlation in between them. So you can refer to the graphs over there, like on websites, etc. That they have nearly same correlation. Then stock market is also indicator. If stock market is doing good, economy is doing good. Corporate profits, income wage growth. Income wage growth means that is like what are the salary hikes that average on average Indian employees are getting. Then unemployment rate, manufacturing, like all the goods manufactured by by the country, housing starts, like uh, the construction of new like new buildings, etc., groundbreaking, and that kind of stuff, and also interest rates. So interest rates by the banks. So like how does that affect economy? Let me tell you. Like, has anyone heard about like repo rates, etc.? If you know, like you can unmute yourself and you can talk about it. Repo rates, reverse repo rates. Okay, fine. That's fine.
Yes, it is the rate at which RBI lends money to banks. Interest rates.
And like, do you know some current news about the repo rates?
Yes, it was increased to 40 points. There was some news.
0.4 points actually. It was increased from 4 to 4.40. So basically, like interest rates are like lagging indicators. Suppose like there is some happening around in the economy of the country, and they affect the interest rate, right? And then interest rates change accordingly to reverse that situation in order to bring that uh, economic instability to the stability. Suppose like if to take a current example, so what happened was like repo rate was they were decreasing the repo rates. So what repo rates is basically, there is some bank, corporate bank, and above that there is RBI. Okay, in US they call it a federal bank. So RBI is basically means the banks of the bank. So basically, what happens is like if banks want the money, okay, money from the RBI for any purposes like their operating costs, etc., or they want to pay out the loans. That's why they want the money. So they'll take the money from RBI for short term. Okay, then whatever the interest is applied by the RBI is called as repo rate. So what happens is like suppose now there was an inflation. Okay, so there was an inflation. There was therefore there uh, there was like high wait sorry there was high demand of the goods, and that's why the inflation came out. Uh, then RBI increased the repo rates. Because of that, uh, banks also increase the interest rates, right? So are you getting this point? RBI, banks, and then big consumers. So RBI increase the rates. Now, like as the rates are high, banks also want to increase the interest rates. So they also increase the rates over the loans and FTs over sorry, not FTs, interest over the loans, right? So what that does is uh, it decreases the consumer spending. So because of the increase rates, like corporates or individuals do not take or like hesitate to take the loans from the banks, and that decreases their spending. And due to the decreasement in the spending, there is decreasement in the demand, and that lowers down the costs, and that's how inflation is controlled. Same as like that's what interest rates. Interest rates just I explained because like I like recently read about that, so that's why I wanted to explain. Then come to industry analysis. So industry analysis, we also talk about a lot of things. Like if someone has any doubt, then you can post it in the chat box, or like if you want to ask me, then you can unmute yourself. Okay. Then in industry analysis, we talk about the demand and supply drivers. So suppose like there are two industries. Okay. Uh, we don't have to compare here. Suppose there is one automotive industry and like they want steel and aluminum. Okay, like their demand is for steel and aluminum. So what are the prices of the steel and aluminum in the current market price? That also affects industries, right? So like what are basically what is the cost of their goods? Sorry, what is the cost of their assets that they will buy? Then it comes to predictability. Predictability is basically prediction in that industry in the current years. Suppose like if you have to take example, then let's talk about IT industry and automotive industry. So in automotive industry, it's kind of likely that they are gonna come up with EV and like better solutions and all that. But in IT sector, it's somewhat unpredictable. Like anytime anything can happen. That's why it's a bit unpredictable, they say, and automotive industry is predictable. Then cyclicality. So cyclicality is basically related to the seasonality or the seasonal performance. So basically, suppose example, we have to talk about ice factory. Okay. So suppose there is ice factory. So the revenue and revenue generated by the ice factory will be higher in the summer than the winters and other seasons. So that's sort like it depends on the seasons, etc. Then pricing power. So pricing power is basically uh, the fluctuation in the prices in the mid time of inflation or a slowdown, etc. That's what pricing power is. Like if it's fluctuating too much, then its pricing power is high. Okay. Then like automotive industry has low pricing power. It does not affect that much. Then revenue stream in industry, then franchise and brand. So basically, franchise and brand means in a country, if you are comparing the industries, then which are the franchise or brand they are operating in that industry in that country. So it also suggests some like positive points for that. Then like for the credibility value, franchise and brands are important up to certain limit. Uh, and then when we come to company analysis, we talk about management, financial statements, financial ratios, competitions against rivals, etc. Okay. It's okay. Like related to this, uh, I can ask one doubt. Okay. Like upon this demand supply drivers. Suppose uh, I want to invest at the like suppose today is like we are in the February 2022. Like at that time, Russia invaded the Ukraine, right? So at that time, like if you want to like buy some stock, then which that would be? Like, can you tell me the guess?
So
There is
basically,
yeah.
what products Russia and Ukraine would be exporting to the world, their demand would increase because there is a lack of those products in the market now. So all the companies which are involved in that business of exporting those products, their stock prices we should buy.
Issue.
We should buy.
Uh, see, come up once again. You said like suppose like Russia is a good importer of oil, then sorry, exporter of oil, then we should buy the oil stocks.
Of the companies which are like exporting oil in the market, because the demand of oil has increased and so they will earn more profits now, so
Uh,
those stocks
but
we should.
what happened in the February was like when Russia invaded the Ukraine. That time, all the Western countries and European countries stopped buying the oil from Russia. So, like, it's bad for Russian companies, right?
Yes, but for example, if Saudi Arabia is exporting oil, uh, then it's good
And
for Saudi Arabia.
actually, like India. like India has no had no role at the starting in the war, and so like okay, let me tell you what happens in the of course you are right, means in different countries like there is different situation, and you talked right about the Saudi Arabia actually. Like in Saudi Arabia, prices of oil prices hiked up that time. So what happened is like I was asking in India we what like which like India is friend of Russia, right? So like kind of friendly. India actually remains neutral, but sometime like but they already made the deal. So let me talk about it. Just listen for 1 minute. So what happened was like at the starting, um, oil prices were decreasing. Okay, when Russia invaded the Ukraine, because like all countries stopped the importing from the Russia, and India also like Russia oil prices dropped heavily at the starting in the February, but in what happened in the first week of March is India announced that they will buy the oil from Russia. Okay, so like and India also took advantage that they buy all the oil at some discount. Suppose like it's uh, somehow like I don't know the exact prices of oil, but suppose it's 500 units. Okay, then India imported those on 400 units. So that was benefit for the Indian oil stocks. Okay, so like wait, let
Yeah.
me. You can tell yeah, what we're asking.
No, I just wanted to add something like, for example, the demand, like the stock prices of Adani Wilmar went up because Indonesia stopped the export of palm oil, and at the same time, since Ukraine was a is a big exporter of sunflower oil also, so
Uh,
in as a result, there was a lot of lack of oil in the market, and since Indonesia was not exporting refined oils at that point, so Adani Wilmar, since it's a refinery of the oils,
Real.
and hence its stock price went up.
Exactly. That's like yeah, really good. Means reading news helps that like that was good. So like let's talk about like IOC. It's Indian Oil Corporation. It's having like highest market cap in India in oil sector. So what happens is was like that at this time around 11 February around they they invaded the Russia, right? They invaded the Ukraine. So after that like there was some down a depreciation in the price of oil market. And then after this, like in India, they started increasing when India stated that they will import the oil from Russia. Okay, and like at the same time, you can talk about aerospace. So which one is that? Hindustan, I guess. Hindustan Aeronautics. So it's basically sector from air. Not it's not airlines. It's aerospace and defense sector. So that time there was a hike in this. Like you can see there is 29.3% return. So after that, because like there was like high demand for this, like they actually at least they suppose that there is some high demand for this in this sector. That's why it hiked up. Okay. So now we'll talk about the annual report of the company. So what annual report? It's basically part of company analysis. But if you are reading some, starting pages of the annual report, then you'll also get the idea of the economy of the industry, country it's working in, and its future prospects of that industry in the economy. So like annual report is a really good way of learning, but most of it is for the company analysis. Okay. For the economy analysis, they release some kind of document every monthly. Like there are some private entities, I don't recall the name of that. I'll search and tell you after the session. But they tell about the global economy, like what is the GDP and etc. All that stuff monthly or quarterly. They release that. Okay, so that's all. That's good for economic analysis. So now let's talk about annual report. So in annual report, basically it's financial summary of companies' activities, like whatever they have done throughout the year, and like how much revenue they generated, how much tax they were paying, and now which how much tax they are paying, their earnings and their growths and etc. stuff, their future prospects, the management, what is CEO's word, what is MD's word in that, and their grounds and their stand in that. So that kind of stuff is included in the annual report. Annual report is released every year after the 31st March. publicly. Okay, but like it's really long, like it's 400. Like I will now check up with the Tata Motors annual report. It's of for the financial 2020 2021. It's 400 pages low. It's not possible to read all of it, right? So it's actually it comes down to these points. Like these are important points of that. So first comes to the director's report. Like what is director stand in it, and like how much director know about like overall situation of the industry economy. These also included in that. What are their future prospects and all that kind of stuff is in director's report. Of course, director must know about everything about the company. So, okay. Then we'll learn about the financial statements. Financial statements. So all this I told you about the balance sheet and the profit and loss and cash flow statements. Then we'll like now in the financial statement, what happens is like there is large number of ways using which they generate revenue or like they use assets. So all that stuff cannot be included in the single page balance sheet or single page profit and loss statements. So they include the schedule and note to the account. So basically, it's basically the note that you if you go on this page, blah blah, then you'll get the accounts of the section. So suppose like there is one section, there is one line in profit and loss, income, other income. Okay, so whatever comes in the other income, they cannot post it in the P&L statement because of the um, space, because there is not that much space. So they'll attach the notes, and like if you go on this page, then you'll get to know about other incomes. So that's what schedules and note to the account says. Then we'll talk about the auditor's report. What auditor's report is basically the first all part that a company has written about its own financial health, economic health and future prospects, वगैरह, and management. But now auditor is also the role in it. Auditor is basically representative of all shareholders, including us who are investing in it. So auditor tells the truth about like whatever like company has told about them in the annual report. It gives a summary and it like tells like how much it's truth and all that stuff is in written in auditor's report. That's why auditor's report is important. It can be the possibility like they are companies exaggerating their results and etc. But if auditor says like yeah it's fine, it's not that much good, but it's not that bad also. Like these opinions can be different, not opinions, facts can be different. So that's why auditor's report is important. Okay, so we'll talk about the financial statements now. Uh, Balance sheet, I already told you these three names. So basically, balance sheet talks about the assets, liabilities, and equities. Now, what are these assets, liabilities, and equities? Like these are some, like heavy terms. Uh, means you might feel like this is heavy terms, but these are quite easy, and we'll talk about them. And now, what are the types of the assets and liabilities? Now, current, non-current, then current liabilities, non-current liabilities. We'll talk about them in the next slide. Just bear with me. Then comes profit and loss statement. So they're actually profit and loss statement. We talk about their revenue generated. Then we talk about their expenses. Then revenue minus expenses give this value EBITDA. Okay. I'll tell about it later also. So don't worry. It's basically earnings before interest, tax, depreciation, and amortization. Okay, so when you basically subtract expenses from revenue, you get EBITDA. Then when you subtract depreciation and amortization from EBITDA, you get EBIT. That is earning before interest and tax. Then we come to the PBT, that is profit before tax. And then when we subtract tax from that, we come up with PAT, that is profit after tax. Cash flow, basically cash flow statement is, like the combination of balance sheet and profit loss statements. Means it tells us about everything that is, the ways through which the cash is going out and in, or cash equivalents also are going out and coming in. They're included in the cash flow statement. So basically cash flow is divided in three types, that are operations, investing, and financing. That is cash flow from operation, cash flow from investing, cash flow from financing. We'll talk about them also, like what are they, what are operations and investing, finance. Okay. If you have any doubts, like you can let me know. Could you please explain what is auditor one more time? Yeah, okay, sure. So what auditor report is basically, suppose in the total annual report, company has given their performance, their financial statements and all that. So auditor basically check the credibility of that report, and they give their own report at the end of the annual report. That's what auditor's report is. That's it.
Who is auditor actually?
Auditor might be, like some CA, chartered analyst or accounting people. Uh, they might be, I guess they are people from SEBI, maybe. Most probably they are people from SEBI and CA, वगैरह, that people.
There is a team or a one person only, a single person.
Yeah, what?
कोई टीम है या फिर एक सिंगल पर्सन ये रिपोर्ट बनाता है?
It should be the team actually. It's not possible for one person, right?
Yeah.
It's a lot.
Okay, I have a doubt.
Let me know.
Okay, so like let's say there's a company like Reliance. Okay, so like Reliance is operating its businesses, let's say oil business, and it hires, let's say, KPMG for its auditing. Okay, now comparing, that's a big company because big companies will be hiring big corporations, right? So like, can Reliance not manipulate them by giving them money and
It actually
But
happens.
then no, it happens, but then how does it, like, we don't see so many cases, but then the government cannot cross check, right? Because they believe that KPMG people have done it right because they know the laws, they know all this
Yeah.
ethic laws and all.
So
Maybe they have done something manipulation in the auditing.
Let me know. So, like suppose you are checking Tata Motors annual report, okay? So you can do two things. You can check one on their company's website, and second one on the NSE website, okay? So if you check them, there are 2 pages included in the NSE's report. That is like, it's checked from the SEBI, like, Security Commission, something like their Board of Commission India, something like that. So basically, SEBI recheck that all the auditors report and financial report. So it's basically after that only they publish it. So what we can say, it's like that only. But of course, like auditor people can can be manipulated. But then it's also like followed checking up is done by the SEBI. So let's talk about the asset terms, balance sheet. Okay, in the balance sheet. So balance sheet is there is balance sheet equation that is assets equals to equities plus liabilities. Okay, we'll talk one by one. What are they? So assets are basically the resources with which then individual or corporation is like making generating revenue, or they are basically doing basically the business using those resources. Then they are called as assets. So suppose there is some IT firm, okay? So that IT firm is using which kind, like what stuff for the generating the revenue? Like, can you just give me some examples in the chat box?
Could you repeat?
Could you tell me? Wait. The examples of assets, like Miss, I just told you the definition, right? Like definition is basically okay. So whatever the resources the company is using to generate the revenue. Suppose like if it's IT firm, then all their computers they are using, it's their asset. The building which they have made for operating, it's also their asset. Offline spaces, yeah, good. They come up with some assets. Sorry.
It can be their manufacturing plants if they have any, their individual manufacturing plants.
Yeah, that can be the plants. Of course, plants are the buildings. Yeah, right. Loans, like loans made or means what kind of loans? Like loan they are making or loan they are borrowing. Loan taken.
That will be liability.
It's not actually that's liability. Like because they have to pay the. That comes under the liability actually. Means I'll tell you what liabilities are. Ongoing projects. Projects are not assets. Inventory, right? Service they provide. services they provide. Services they provide. It's not asset like services they are providing. Okay, yeah, they are assets. Sorry, I'm sorry.
Like
They are assets. Right,
once
wrong.
loan is taken, isn't it a asset?
Yeah.
It's a liability also, but it's also an asset. Like company can do whatever it wants with it.
See, uh, actually, so what happens is like suppose you are taking some loan, right? And now you are using that loan to purchase any computer, right? That computer is your asset. That loan is not your asset. Okay, so are you getting this point? Computer which you purchased using the money from the loan is your asset.
Yes, it's that only. Okay.
International bonds they make. Basically, international bonds they make means yeah, that also comes into investment in assets such as like if like as we invest our money in different securities, company also invest their money in different securities, so that's also their assets because they're gonna make profit by them also. Patents, yeah, patents, right. Patents are intangible assets, we'll talk about them. Wait, okay, let's move forward. Okay, so these are the examples of assets, then using which like there are two categories, physical significance and convertibility. Physical significance, like you can literally touch these physical forms and assets. They are basically inventory, lands, buildings, financial assets. Okay, basically you can touch the computer, right? You can touch the land. That's big, but yeah, like lands, buildings, financial assets are physical, tangible assets. Sometimes financial assets are not considered as tangible assets. Like they are considered totally in a different category that is called as financial assets. But if you just have to talk about tangible and non-intangible, financial assets comes into the tangible assets because they have some underlying value for that. And intangible assets such as patent, the financial assets you can consider like investment in stocks or investment in bonds, etc. That comes in the financial assets. So intangible are like they don't have physical form. Okay, so suppose uh, like I heard recently that Chennai Super Kings have brand value of 2,700 crore. So that is some intangible assets. I'm not sure if that can be included in the balance sheet or not. Might be, but goodwill is of course included in the balance sheet. So what is goodwill is basically means brand value can be included, but after some transactions only. Suppose Chennai Super Kings is acquired by some other company, right? Of course, because of its brand value, Chennai Super Kings will be, you know, like purchased with some extra amount than its real value. That extra amount can be its intangible asset. So that kind of things come into the intangible assets. Goodwill is about the same, and means goodwill is basically suppose that the same example, like so ABC company, XYZ company, ABC XYZ's real value is 40 crores, and now ABC has acquired it with the 50 crores. Okay, means are you getting this point? 40 crore, its real value, 50 crores, its a transaction value. So the difference is will be goodwill. Okay, then comes current assets. Like what are the current assets? Suppose, like let me tell you example. Example will be better for this. Um, Suppose you have taken one. Suppose you have a juice shop. That's better example actually. Suppose you have juice shop. Okay, then then you are making the juice with mixture and fruits, right? Like now that mixture you can use for 2-3 years. Means that will be still working after the financial year. Okay, after the financial year, right? So that comes under the non-current assets, and the fruits they were using comes into the current assets. Okay. Uh, okay, let's talk about the cash flow statements. Really, it should be like this. So let's talk about the terms related to is cash flow statement. Okay, so cash flow is basically a statement is breakdown is a breakdown of three parts. That is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Like uh, pay attention here somewhat. It's a bit tricky in between investing as activities and financing activities. Okay, so let's talk about operating activities first. Suppose like the company is like there is one company they are working and their some core business is something else like suppose like it's Tata Motors. So their core working is basically making motors, right? Making automobiles. That's their core uh, business. So while working on that, uh, they have to operate the business, such as like suppose they have to pay the wages to their employees, like rent and light bills for the buildings they are operating in, income tax payments, and sales and good services. So sales and good services, basically they are selling their cars. They're also selling their services, like suppose like means repairing of the cars, etc. That kind of stuff come in the sales and good services. So basically, whatever is like related to their core business comes under the cash flow from operating income activities. Then there is cash flow from investing activities. Now, like okay, cash flow from purchase of sale of assets. So basically, now the company is also having some revenue generated, but like and they have some money in their reserve, okay, and they don't want their money to settle, like means it's the settle money is like waste anyway. It's not good for anyone. Like you should invest that money, right? So what they'll do is they'll invest that money, okay, invest that money in some other securities such as stocks or bonds. They prefer liquid securities, basically because they might need the money anytime, because that's why. So, but like the examples that I have given is purchase or sale of assets, loans made or received, inventory purchase. So what happens is like suppose the company is like having they're using some milling machine. So milling machine, they are it's their investment actually. Okay, it does not come under the operating activities. Operating activities kind of regular things, that is like sales or good services, wages, rent, and all the like inventory they're buying, the inventory they're purchasing, that comes into the investment activities only. Or suppose they have invested in the some bond, okay, so like whatever they are getting the profit from that, they use for purchasement of inventories. That's why that comes into the investment activities only. And like how the financing activities are different, they are morely related to the um, investment in the self company. Suppose the shareholders of the company are investing in that company, okay. Shareholders are going to, so suppose like it's Tata Motors and its VC firm has uh, decided to invest in that company, okay, like they want to invest money for some project on large scale. So that comes into financing activities. Then suppose company wants to give the dividend to all their investors, that also come into the financing activities. Stock repurchase, that is buyback of stocks, okay, and that comes into the financing activities. Bonds payouts means suppose like as company uh, you know pub, as company make the stocks public, at the same time they also release some bonds. uh, Suppose they are taking some bonds, so what happens is like they have to pay the coupon payments and uh, principal amount to to the bond investor. Basically, it's bond. I guess we have not covered bond in any other thing, other workshop, so you can skip to that part right now. That's fine. Liabilities, maturity. So liabilities. So legally binding obligations that are payable to another corporation or entity, such as loans, accounts payable, mortgages. So basically, suppose a company has some debts on other corporates or other entities or other banks, then that comes into the liabilities. Whatever, suppose at some points their accounts payable, it's also come into the liabilities. What is accounts payable is, suppose you have taken some goods from other companies. Suppose you are Tata Motors, so you have bought some steel from uh, any other company. Okay, so what will you do is like you have taken the steel, but you haven't paid them yet. So that comes into the accounts payable. So what is their physical significance? Same like physical significance, tangible liabilities. Tangible liabilities are financial liabilities, accounts payable, deferred revenue. So like what is deferred revenue is basically that's the same. Like there is one like excess of revenue or excess of or the less of revenue you have generated from the accounts book you have written it. Like I will tell about the deferred tax. You will get clear idea. Suppose there are two books, okay? Tax book and there is one, sorry, account book and tax book, okay? So in account book you have to write how much tax you have to pay, and in tax book you will write how much tax you have paid. Suppose you have to pay 1,000 and you have paid only 500, okay? Then that 500 is deferred tax. It comes into the liabilities. Suppose 1,000 is the tax to be paid and you pay 1,500, then it comes in the deferred assets. Okay. So just let it clear. Wages, dividends, interest payable, etc. Debts payable over the long period, etc. So that's same like debts payable over long period, non-current liabilities, current liabilities that are wages, dividends on short term period do not have physical form, that is letters of credits, etc. Those of financial statements are of three types as I have discussed earlier. Then it's assets equal to liabilities plus equities. This is the equation of balance sheet. Then we will talk about EBITDA equals to revenue minus expenses that I have already told you about, and cash flow statements, operating activities, investment activities, and financing activities. We'll talk about them. Okay, so this is basically the balance sheet of Tata Motors. Let's talk about them one by one. Okay. So what is property, plant, and equipment? So as I've told you earlier, no, it comes in non-current assets. Of course, like if they are building some plant, then its average life must be over the 1 year, of course, right? That's why it comes into the non-current assets, and you can see it does not come into the like non into the current assets. And suppose there is by chance like there's some property, plant, or equipment which is like for very less time, like they have built and like they don't have anything, then they'll put it into other current assets. Okay. Then capital work in progress. So suppose there is one building, okay, which is under construction. Suppose Tata Motors is building one company somewhere, okay, and now like all the money they have spent yet, like till now, in that construction comes into the capital work in progress. After the construction of the construction of the building is completed, that converts to the property, plant, and equipment. Okay. Then use assets. Right of use assets is basically suppose Tata Motors is working in one building, but which is not owned by them. Okay. Now, like so whatever lease they are paying on that comes under the rights of use assets. Okay. Means it's their own. It's their right to use that asset currently. That's why it comes into that. Then goodwill, I have explained. Other intangible assets. Then intangible assets under development. Intangible assets under development. Investment in subsidiaries, joint ventures, and associates. So basically, if you check the annual report, then you will get to know about the subsidiaries, joint ventures, and associates. So this is balance sheet of Tata Motors, right? So they have large amount of subsidiaries and joint ventures. Like Jaguar is their joint venture, okay? And there might be associates. Like there is some criteria, like how much percentage of that company Tata Motors own. Upon that, like this is decided, like if it's subsidiary or if it's joint venture or if it's associate. Okay. So they also make some invention. It's actually consolidated balance sheet. So what is consolidated is it also takes consideration of the investments made into the subsidiaries. Okay. So all these figures you are seeing are considering all their subsidiaries into the account. Then financial assets, investments, loans, advances, other financial assets, non-current tax assets. Okay, so tax assets and other non-current tax assets. If you have any doubt in the non-current assets, just let me know. So this is same like investments. What are they doing? Loans they are making out, means it's not what loans they are taking from someone. It's from loan they are giving out. Suppose they are giving loan to some corporate, then it comes under this other financial assets that are, if there are any other securities they are investing in, that comes under this. Okay. Then non-current tax assets. So suppose like I already talked about deferred tax, right? So it is non-current tax assets. It's also a part of that only. Like whatever uh, whatever tax they still have to pay, they're using is as asset by telling the entity that yeah they're using it as assets. It comes under the non-current tax assets and other non-current assets. Yeah, you can see. Are there any doubts in non-current assets? Like there might be, like new terms in other balance sheet equations of the other companies, but like you can just Google it out and, learn as much as you can. Okay. Are there any doubts? Non-current assets. Okay, let's move to the current assets then. Okay. So current assets, inventories, same. Financial assets. Inventories are basically machineries and etc. All they are using. Okay. That's the same. I had talked about it, I guess. Then financial assets, investments, trade receivables. So what are these trade receivables are? Uh, Suppose like you have made some trade, like you are Tata Motors, right? Then you have given out some, you have made some deal with another entity that you will, give out some cars for this and so prices. But you have given that you have make the deal like means from your side you have given them their cars but they haven't paid it, so that comes under the trade receivables. Cash and cash equivalents, whatever the cash equivalents like bonds or wagera etc. Cash and cash equivalents are basically liquid assets, like they are paid, so it's actually cash or their cash equivalents. Because they're liquid they can be converted to the cash anytime they want. Then bank balances other than three above. Okay, then loans and advances, that is same like this only. Loans and assets, they are advances they are making up. Then other financial assets classified as held for sale. This is basically suppose there are some assets, okay, and they are classified like means like it's opposite to trade receivables. Like they have made some deal with some entity and now it's fixed that these motors will be like sold out to some specific entity, so that's comes into under the asset classified as held for sale and other convertment assets. Now you can see like like what is the total assets here is 65,000 and 59.66 crores. Okay, this is what, and like one more thing is it is written here as at March 31st. I guess I have told you earlier that it is not like uh, restricted to some period, but it's from the first day of the life of the company to as on date given in the balance sheet. That is 31st March. Whatever assets they have uh, bought and they're using for the generating revenues, etc. That comes into these assets. Are there any doubts? I guess not. We'll talk about the balance sheet liabilities. Okay, equity share capital. Why equity is in this section, like equity and liabilities is because like suppose like you have given out the money to these companies for their shares, right? But like share is not like something, it's just a certificate, right? Like whatever they are buying in, whatever they're using our money is, they're using our money, right? Like we are just investing. Like we are not using our money right now, but we are giving out that money to that entity for their use. So it comes under the liabilities only. That equity plus liabilities equals to make out equals to assets. So equity share capital is basically uh, whatever this comes into the consideration with the face value. if you divide this 765.81 by its face value, then it comes the total shares like they have made public, okay, and other equity there. Then non-current liabilities, financial liabilities, borrowing, lease liabilities, other. So basically, borrowings means whatever they have borrowed from. Lease liabilities, like if someone has given out your lease, then you still have to pay their rents. Then that comes into the lease liabilities. And then provisions. Provisions are basically, suppose like uh, there is some kind of asset, like means you have saved your some money of that company for purpose of some fixed purpose, that is called as provision. Suppose like you have decided you will use this kind of like this much money for this project and it's fixed, okay, then it comes under the provision. Then deferred tax liabilities, it's same as I told you earlier. Then current liabilities, financial liabilities, borrowings, trade payables, same, I have talked about it earlier. Acceptances means uh, acceptances means suppose like you have taken like it's same as these only. Actually, it was not in this part. Okay, fine. So acceptances is basically whatever the money you have to pay out for the good you have purchased from any other entity. That comes under the acceptances. Other financial liabilities, provisions, same. Current tax liabilities, nets, and other current liabilities. So you can see like total equity plus liabilities 65059.66. It is equal to the total assets. Okay.
What is lease liability?
Lease is basically suppose like you are Tata Motors, okay, and you want to operate um, in some sector, and you want one building to operate in. Then you are taking it on a lease, on a rent kind of thing. Okay. So you'll pay out the rents for the lease and that kind of stuff. That comes in the lease.
I think lease is a contract, right?
Yeah. Actually means whatever the like this kind of stuff that happens with the giant entities, that happens with the contract and receipts and all that. Like if you like even if you are working with some small entity, then you will have to make receipts and contracts with all those things. Then only this high deals work. Okay. Profit and loss statement. It's basically revenue, and then other operating revenue, uh, revenue expenses. You can see like revenue is basically their sales and services. Then you can generate the total revenue from operations. This is then your other income is 842.96. Then you can see like here on these are the notes I told you about. Like you can go through 33, then you'll see about the other income of that. I'll send the annual report of the Tata Motors after that. You can check out. Okay. Then its total income is this expenses. Uh, expenses. Fine. So expenses is cost of materials consumed, purchase of product for sale, purchase of products for sale. Then changes in inventories of finished goods, work in that are like self-explanatory things. Employee benefit expense. Employee benefit expense is basically like suppose you're taking policies for your employees, or you are like giving out them goods and specs, etc. So that kind of stuff comes in the employee benefit expense. Then finance cost is basically suppose like you are investing in some options, okay, then options kind of derivatives, so then you have to make some payments such as premiums, and after the dealings you also have to pay whatever the rest of the money that you have to pay, that comes into the finance costs. Then foreign exchange loss, self-explanatory. Depreciation and amortization. Okay, let me talk about depreciation and amortization and what are they. Okay, so I already talked about the tangible assets and non intangible assets. Suppose you have taken one okay AC. Okay, for your company you have taken one AC, and it's average life span is 6 years. Okay, and its cost is 30,000. So like in the next year, you will add just only 5,000 rupees in that. Okay, so you got it. Like you will depreciate its amount expenses, such as like if you are written here 3681, okay, uh, expenses, depreciation and amortization. Basically means you add 6,000 every year. That's how it works. Depreciation. So amortization is basically about intangible assets and depreciation is about tangible assets. That's it. Product development, engineering expenses, other expenses, amount of transferred to capital and other accounts. Employee separation cost. Employee separation cost is basically the cost. You suppose you have to company has to terminate some employees, then it comes with in the cost. Like you will have to pay out some policies payments, and you'll also have to give. You will also have to conduct some new interviews and new process for hiring in new incomers. For that, it comes under the cost. It is called as employee separation cost. Then write-off provision and tangible assets. So write-off is basically suppose you have some asset and its value is decreasing over the year. Okay, so like suppose that comes into the write-off. Like it's not like depreciation and amortization. It's different. Like suppose write-off is basically suppose it's like a depreciation cost was 5,000 rupees, right? But suppose its value is now below 5,000, like means 3 years have been occurred already. Then what will be it raised value 10,000. Okay, now 10,000, but it's now suppose like it is in such a bad condition that it's just value 6,000. Then write-off comes into that, and that's also actually this value. Then impairment losses. Okay, wait, sorry. Impairment losses are the same as of write-off. Just in this case, like it's kind of same in passenger vehicle businesses, but just impairment losses are related to the core business of core assets of that company. Then current. Then these are like let's talk about like I talked about this EBITDA etc. Right? They have added this depreciation and amortization here. Suppose they delete it from here, then it will be like revenue minus expenses. They'll come about with the EBITDA, and then if they subtract cost of depreciation and amortization from that, then it comes EBIT. But like they have made in some other way, like they haven't done this in this format. But if you see like other statements, you'll see them in this format only. Okay. Okay. Then earnings per shares in Avira. So basically here we talk about the profit before tax and after tax incomes. We talk about the profit and loss over the year, like from the continuing operations. The earning per share. That's basically, and some other comprehensive income that we have missed here are written here, and then we come about the total comprehensive income or loss for the year. So this was their profit or loss in that year. Okay. Then earning per share will be like told you about later in next slides. So like
I had a question.
Yeah.
Is the profit and loss statement the basis for the balance sheet?
No, actually, means they have some different purposes. See, means of course, like they are very much linked, and like I also wanted to take some part over this balance sheet. What is the linking between balance sheet, profit and loss, and cash flow statements? They are highly related, of course, but it's not like something like it's made on the basis of that. Cash flow is made basically on can be made on the basis of profit and loss and balance sheet, but profit and loss and uh, balance sheet and profit and loss can be made independently. So, is that was your doubt? Was that your doubt?
Okay, thank you.
Yes. Okay. Okay. Let's talk about the. I talked about this. Okay, cash flows from operating in activities. So profit and loss, like they state actually first profit and loss, and then they come up with all operating activities. From here on, their expenses and their cash in cash outs are started. So depreciation amortization, as already told. Allowance for trade and other receivables. Allowance for trade is basically, suppose you have given out some like suppose someone has to make you payments for the loans that you have made them, then there is some risk associated with it, right? Like there is not 100% guarantee that they will pay your money. So that comes under the, and after the consideration of that risk, you come up with the allowances for trade and other receivables, and that is this one. Okay. Inventory write down, I told you earlier what is a write down. Then provision for loan, this provision we have talked about. Employee separation cost we have talked about. Impairment loss we have talked about. Share based payment. Share based, no, I'm not able to recall this. Okay, so I'll just tell you after searching what is share based payments. I'm not able to recall that. Sorry. And investment at fair value through the investments measured at fair value through the profit and loss. Okay, right of provision, it's same. Loss on sale of assets. Suppose like there is some sale of assets that you are doing, like there is some scrap assets that you are going to sell, then that comes under this only. Like whatever the return of that assets that do not have any more value. Okay, so you can sell them, and it's actually called as recoverable payment, and that comes under the profit and loss. Profit on sale statement. Sale of investments, whatever investments that you are making, suppose means and the profit that you have generated through the investments, that come into that. Tax expense, finance costs, we have already told. Interest income and dividend income are basically whatever, suppose you have made some investments, then the profit from that comes into this. Foreign exchange. Cash flow from operating activities before changes in following assets and liabilities. Trade receivables I have talked about. Then other current liabilities, that you can understand whatever it has written. It has been written here. Okay, it's like I have actually exactly completed all the terms. It's just share based payments. I'm not able to recall what it is. Okay, so there is net cash from the operating activities. Then there is cash flow from investment activities. Like we already talked about it, what it is, like property, plants, equipments, then other intangible assets. Okay, so this is generally investing activities are generally cash out, means like you are paying out the money, you make the investments, whatever the profit you are making through them, then you invest that money in some your assets, and that is called as investing activities. That's why it is cash out. Okay, sale of business to subsidiary company, investment in subsidiary companies, investment in mutual fund, loan given to subsidiaries companies, the sale of quoted statement. Quoted investment means suppose there is some private entity which is not you know uh, which is not listed it on the stock market, when then that company is unquoted. Sale of quoted investment, others. So you had taken some investment into that, you had made some investment, but now you are selling that investment. So suppose you have taken some shares in private company, and then you sell out that. So whatever the profits you are making from it, it comes under the sale of quoted investments. Then deposits and restricted deposits, financial realization of deposits with financial realization, interest received, dividend received, again about same things. Okay. So financing activities. So this is the last part of cash flow. So what happens is here, like we talk about the financing activities. So let's start. Let's start with, like, there are some 2 to 3 minutes it will take. Proceed from issue of shares. Suppose like they're issuing the shares, like new shares by stock split or bonus issue. Sorry, not using stock split, only bonus issue. Then it comes under the issue of shares, or they want to generate more revenue. Then it comes under the issue of shares. Then long-term borrowings, repayment of long-term borrowings. Suppose suppose they have taken some borrowings from some company, corporate or entities such as government or uh, like that, then it comes under that. Then whatever repayment they have done from the old uh, borrowings, that comes under this opinion settlement and repayment option settlement of long-term borrowings, same like this kind of stuff. Matured fixed deposits, like a bond has some maturity, right? So like means company might issue some bonds, okay, and when the maturity of bonds get finished, they have to make the repayment of that principal plus all the coupon rate, coupon payments on that to the investors who have invested in that bonds. So that's what repayment of matured fixed deposits. Proceeds from short-term borrowings, repayment from shorting, same all that kind of stuff. Dividend paid, whatever dividend they have paid, interest paid. Interest paid means like if they have taken some interest and they are making payment on them, or even the coupon payments also come into this, whatever, like okay, coupon payments are like new stuff, like bond stuff. We haven't taught you bond, what are actually bonds and how do they work, but you can like stay piece on that right now. Like increase in cash flow, cash equivalents. So, yeah, yes, that was all. Okay, that was all from my side, guys. Now Ramashish will take over. Okay. If you have any doubts, you can post it in the chat. I'll answer.
Yeah. Um, Hello, everybody. I'm Ramashish, and I'm assistant quant researcher at IIT Kharagpur. Quant. So I'll start with the ratio analysis. Okay, so everybody can see my screen. Just do a +1 check. Yeah. So I'll just start with ratio analysis. So what ratio analysis is basically is key, like in past hour we learned about a lot of terms in the financial report. So now for suppose you want to invest in a stock or something, so you want to do some analysis on those reports and come up with a answer that yes, I want to invest here, I don't want to invest here, it's a good option, it's not a good option. So for that, making it easier, like people have came with a lot of terms, and it is in terms of ratio because we are dealing with numbers. So first is solvency or financial risk ratios, and that deals with how risky is the investment. Then there is financials, profitability, growth, and operational. So before I get started, I'll just share this spreadsheet with you so that you can follow along. I've pasted it in the chat. So if anybody is getting problem with opening it, just do a +1 in the chat. Okay. So now I'll start with solvency or financial risk ratio. So first one is debt to equity. So what it is, debt is something that is a liability to the company, and equity is something it has borrowed in in some sense from the shareholders. So what we get from this ratio, debt to equity ratio, is ki how much is our debt and how much we have equity. So in a very good scenario, it should be strictly less than 1. And then next is debt is to asset. So debt is to asset means how much debt we have and how much total asset the company has. So this ratio should strictly not go above 1, because if suppose there is a XYZ company and it has debt more than the asset it has, it means that the company is in loan itself, like there is not worth to the company. Then there is a current ratio. So current ratio deals with how liquid is the company. So with liquid, I mean ki how much money they have and can they pay their all short-term obligations, their short-term loans and all those things that has been generated in the year. Uh, Another more quicker way of this current ratio is quick ratio. What happens in quick ratio, we
we subtract the prices of some of the assets of the company that can't be sold. So suppose there is a company and it has some kind of equipments that can't be sold very easily. So we subtract those money and come with a number that is called quick ratio. Then next is interest coverage ratio. So what interest coverage ratio is key. Suppose there is a company and it has taken some borrowings from other persons and it is paying an interest of 5 rupees to all these people that it has taken money from. So interest coverage ratio says that how much money it will generate from that 5 rupees. So suppose it will generate 25 rupees from those 5 rupees that it is paying as an interest, then the interest coverage ratio is 5. So next, here are some formulas for these calculations. And meanwhile, we'll just run this formula on Tata Motors stocks. So let's start with debt to equity. Here it is. So for debt to equity, what we will do is we will go here and take the total share capital, total reserve and surplus, and just long-term and short-term borrowings that are the liabilities to, and we'll calculate this debt to equity ratio. Now, when we'll go to debt to asset ratio, we'll just take the long-term and short-term borrowings and divide it by total assets. So that is liabilities among the assets. Next term is our current ratio. So for current ratio, what we will do is we will take the trade payables, the short-term borrowings, and the total current liabilities, and we will divide it with the trade receivables, inventories, uh, total current asset, and cash equivalents. And when we will come to the next thing, that is quick ratio, we will just remove this inventories because like we can obviously not sell the inventories of a stock, like of a company. And the next is interest coverage ratio. So this is basically the income it will generate. Like, sorry, total interest before tax, and we will divide it by financial cost. So that will give us the how much money it will generate from the interest that is paying. So if anybody has any doubt till here, you can just unmute yourself and ask me. Then I'll go ahead. Okay, so if there are no doubts, I'll just move ahead. So next are operational ratios. So these ratio deal with how is the operations going on the company. So the first is debtors to sales. So suppose there is a let's just keep it standard with Tata Motors everywhere. So suppose Tata Motors has given a car to its franchisee, and the franchisee sold the car, but yeah, you can ask. You want to say something, Atul?
Sorry, it's just by mistake.
So what suppose this car is the franchisee sold the car, but the money has not been received by the Tata Motors company itself. So in some scenario, suppose that 80% of the money that has been sold and is still with the franchisee itself. So this ratio tells ki how much money has Tata Motors received from the franchisee after the product has been sold. The next is asset number. So asset number basically means that the amount of revenue the company is generating from the total assets it has. Like suppose the company has asset of like suppose 1,000 crores. So how much revenue it is generating from those 1,000 crores. And then there are some straightforward things now. Receivable days is basically the how much days it takes for the like Tata Motors to receive the money. Like suppose the franchisee sold something and it want to receive the money, how much days it will take to receive the money. Inventory days is basically suppose Tata Motors built a car and how much days it will take for the car to uh, like get out from the factory and go on the streets. So that is inventory days. And then is payable days. So payable days, what it means is ki, suppose Tata Motors has taken some money from steel plant, like not money, steel from the steel plant, and it has not paid it yet. So, or like suppose they are selling insurance along with cars, or like maintaining your cars. So it has to pay money for that. And how much money does Tata Motors, how much days Tata Motors take for those money to pay? So those are payable days. The next is cash conversion cycle. So what cash conversion cycle means the length of the time and that takes the resources to go in a cycle. So the formula for it is receivable days plus inventory days minus payable days. So ideally, in an ideal situation, this number should be like zero or negative, because like it should not be that Tata Motors has paid its like subsidiary companies beforehand and it will receive payment afterwards. So we'll just go to sheet and see this ratio. Okay, this is returns to sales. For that, the total trade receivables and which we will divide it with the total revenue it has got. Like the revenue we have got and like trades that with the revenue, and we have divided it by the trade receivables, like how much we have received. Next is asset turnover, that is revenue generated for each asset, that is total asset and total revenue. Uh, Next are straightforward things, the receivable days and inventory days and payable days. And after doing it, like 52 plus 15 minus 92, we get minus 24. That is the cash conversion cycle for Tata Motors, which means like Tata Motors pays after 25 days, it has sold a car. Like it, suppose it has taken steel for somewhere, it will pay the steel plant 25 days almost after the that car is sold. So anybody if has any doubt till here in operational ratios, they can just unmute themselves and ask me the doubt.
Like, how did you come to this conclusion that it takes 25 days? Can you repeat it?
And it will be in the financial report that we were talking about. Okay, how much days it is taking for receivable, the inventory, and the payable for the company.
Okay.
Next is financial ratios. That tells us about the financial status of the company. The first is adjusted EPS. So EPS stand for earning per share, and the adjusted EPS is basically suppose a share is of like 340 rupees, and we give a dividend per year 10 rupees. So adjusted EPS will be 330 rupees because the total earning uh, is 330 rupees because we have given a dividend of 10 rupees. Next is cash EPS. So it basically means how much cash the share is generating, because it could be different from earning, because think in a sense that we have a share and for each share we have bought some inventory items for us. So those inventory items can't be like converted into cash. So we want to get the exact amount of cash that we'll be getting from our EPS. Next is book value per share. Uh, we will just look into its formula, and that is pretty straightforward. It is basically uh, the total, the minimum value of the company that can be speculated from the balance sheet and like financial report. And what this book value per share tells us is that suppose there is a company whose book value is 500 rupees, and due to some reasons its stock is like moving on 400 rupees, then it is undervalued. And there are, if other indicators give a good sign, we can just buy that stock. Next is a dividend per share. That is basically the amount of dividend a company pays to its shareholders in exchange of for them buying the share. Usually, dividend is not paid by companies that have a lot of debt. Like in the case of Tata Motors, it is not paying dividend right now because it has a lot of debts. Next is free cash. Free cash is basically how much cash a company is generating while it's maintaining its capital assets. Like it's not like selling any of its assets and maintaining everything. And then if that operation is going well and good, then how much cash it is generating. So for your purpose, I have attached the formulas for this, and we'll just go to the spreadsheet and see this. So the adjusted EPS. So adjusted EPS is basically net income that the company has generated divided by the dividend it has given, and it is divided by the number of shares that it has given in the market. Next is cash EPS, which basically means how much cash it has generated for every share. So the formula for this is the net income and depreciation and this thing. We add those things and divide it by the number of shares. Next is book value per share. So book value, calculating for the book value, will just add the total share capital, total reserve and surplus, and we will divide it with the number of shares that are currently in the market. And next up is dividend. So Tata Motors currently is not paying any dividends till 2020, so it's zero. Next is cash from operating activity. So this value is also in the financial report. Next is capex, and this is also in this number is also in the financial report. And what capex mean is basically the cost of maintaining the inventory. Like suppose Tata Motors is a factory, they will be surely spending a lot of money on maintaining the factory, like for the good working of the factory, because like some machines might broke up or anything like that, or they want new machines. So this is the capex thing. And when we just subtract these two numbers, we get the free cash that is being generated. So here the free cash is minus 3069. That means Tata Motors has actually generated minus 3069 stocks, 69 free cash, which means it has it has to pay this amount of cash for the working of the company for that year. And free cash per share is basically will divide it by the number of shares. So basically, suppose Tata Motors stock was 300 rupees, so it has spent 9 rupees per share for this cash flow, for maintaining the cash flow. So if anybody has doubt here, financial issues, you can just unmute yourself and ask.
What is free cash?
It is basically the cash that is generated from operating activity. Like suppose the company is operating and it has generated 1,000 crore rupees of cash, and then we will add the capex in it, like the amount of cash it has spent on the machines, inventories, giving salary to its employees, and we will divide it by the number of shares. That will give us free cash per share. And if will not divide by the number of shares, it will be just free cash.
Capex, we will add it in minus with minus sign or with the plus sign only.
Capex is in here. Capex itself is in minus sign, so that's why I just added.
Okay.
So next is profitability ratios. Just a second. So profit in the profitability ratios, first is return on capital employed. So it what it means is how much return we have generated on the capital that is that is been employed. Then is ROIC, that is return on invested capital. Like invested capital means uh, like invested capital means that the amount of invested capital, a lot of things in the factories are just stay there. They are not invested in some sense. So in ROIC, we try to calculate the return on invested capital. Next is return on equity. So equity basically means the amount of money that we have got from people uh, by selling them the shares of the company. So we'll calculate the return on equity. Then there is return on assets. That means the total assets that the company has right now and how much return it will generate from that asset. Next is operating margin. So what operating margin is basically, uh, suppose there is a company, a Tata Motors company, and it is generating a nano car for 90,000 rupees and it is selling to the customers for 1 lakh rupees. So there is an operating margin of 10,000 rupees. For the operation, for this operation, they have a margin of 10,000 rupees that they will get. And there is the cash profit margin. So the 10,000 that we have got might not be in cash itself. It could be in some other non illiquid forms. So the cash profit margin tells that how much cash we have got. The formulas for this are here, and I'll just run them on Tata Motors. So the first is ROE. So this is earning before interest and tax, and we will divide it by the total share capital, total reserve and surplus, long-term borrowings, and our short-term borrowings for return on uh, capital employed. Next is return on invested capital. So for return on invested capital, we will take net income and divide it minus, and we'll just subtract the dividend that the company has given to its stockholders and divide it by the same numbers that we used in the previous one. Then there is return on equity. So for that, we will just take the total share capital and total reserve and surplus, and we will divide the net income with this. So we'll get the amount of revenue that has been generated on the equity. Next is return on assets. For this, we take average of the assets of 2 years. So just see, we have taken average of the assets of past 2 years, and we will divide the net income of that year, the current year for which we are calculating, and we'll just divide the net income with the average of assets. Next is operational margin. So for operational margin, we'll divide the earning before interest and tax with the total revenue. So this is operational margin. First, we have generated a revenue, like we have sold something of 264, 26, 2,64,041, and we have earned like lost 3,336 pounds.
Then there is net income is in negative. So
Yeah.
where, yeah, so it is a loss kind of.
Yeah, it was in a like Tata Motors was in loss in 2020. But like Tata Motors, like Tata is a very big company, so like its subsidiary companies, like suppose Tata Motors is losing a lot of money, but it could be TCS is generating a lot of money, so they just transfer the money from here to there, so that they can keep the company working.
Okay.
Next is net margin. So for net margin, we will take the net income and divide it by the total revenue. So that is the net margin. And the next is cash profit margin. So for cash profit margin, we'll take the net income and add the DNA in it, and then divide it by the total revenue that we have done. So that ends cash profit margin. If anybody has any doubt till cash profit margin, you can just mute yourself. Then there is growth ratio. So growth ratio basically tells you how well the company is growing. So the first is revenue growth, which is very straightforward. How much money it has, how much money, like delta money generated divided by the money of the previous year. Then there is operating profit growth. That is the same thing, like how much growth is there in the operating profit, how much growth in the net profit, like operating profit, net profit, all these things like we covered in the past time. Next is EPS growth, like of earning per share, how much growth we have got in the earning per share. And the next is book value growth, like the book value of the stock has it increased or decreased. So the formulas for these things are here, and I'll just run them on Tata Motors ones. So the first is revenue growth. So so here is revenue growth. We have taken the revenue of past year and like this year minus past year divided by past year. That is given the revenue growth. It is also called the year-on-year growth of the company. Next is operating profit growth. So this is basically EB, earning before interest and tax divided by the total revenue. Then is net profit growth, which is basically the same thing, like net income divided by total revenue. Then there is EPS growth. So for EPS growth, we will earning per share of this financial year subtracted by the earning per share of the previous financial year, and we will divide it by the price of that earning per share of the previous year. And next is book value growth. So we will, for this we will just do the same thing, like subtract the book price of this year with the book price of previous year and divide it by the book price of the previous year. So if anybody has any doubt till here, just unmute yourself.
What is that FCC?
Uh, where it is free cash, I think.
FCF.
Free cash. Free cash. So like there are other quantities used in valuation. So one of them is expected return. So expected return is basically we will just extrapolate the things. Like suppose the stock price of a company has grown like suppose 10% in the past year. So the expected return will be 10%. Then next is market capital, which means basically uh, of the uh, how much of the capital is in the market. Like suppose recent times you would have heard that LIC IPO, and it was one of the biggest IPOs of India. So LIC, I think, generated a market capital of 20,000 crores in that IPO. Then there is dividend yield. So what dividend yield means? How much dividend the company has paid out to its shareholders. Next is PE ratio. So we'll just talk about PE ratio and PV ratio while calculating things. Next is EPS future growth rate. So EPS future growth rate is basically what will be the growth rate of EPS in the future. And for this, we use some statistical methods to calculate the EPS of the next year and more thing. And next is PEG ratio. That basically means ki for an investor to know ki how much risk-free is his investment. So for PE ratio, we just take the maximum of zero and share price and divide it by the earning per share. Uh, we do this because, like, suppose a company has PE ratio negative, that doesn't make any sense because it is losing money, kind of. So we don't so we look into P ratio then. And a very high P ratio also not very ideal. Currently, Nika has a P ratio like above 1,000, which is very not very admirable. A P ratio should be a very ideal range. We'll just run these formulas on Tata Motors stocks. So the share price in 2022 was 71.05. So the expected return is basically 71 minus 174 and divided by 174. So we'll get around minus 60%. So the expected return for Tata Motors was 60%. That means basically like a person invested in 2019 has lost 60% of his investment. Next is market capital. That is basically the share price multiplied by the number of shares. Next is the dividend yield. That is 0 for in the case of Tata Motors because they don't pay any dividend. Next is PE ratio. Since like EPS of the Tata Motors is negative, so the PE ratio is 0. Next is PB ratio. That is basically share price divided by this, uh, book value per share. So what's the share price right now and what is the book value of it? It just gives the information about it is it undervalued or overvalued. So in case of Tata Motors, it is undervalued. Next is EPS future growth. So we just calculate it using EPS values. And next is PEG growth ratio. So for that, we use the P ratio, and it's like when this sheet was met, we had information only till 2020, and we had like came up with a number for 2021, and then we divided them both and got a PG ratio, and a PG ratio of zero means like the investment is like kind of risk free, and there are very high chances that the stock will go up. And like the same thing kind of happened in the case of Tata Motors. Like from 71, I think their stock is right now, I think 300 or 400. Their stock is right now 430 rupees. So P ratio, yeah, that this PG ratio showed that. Next, we will come with like a score kind of thing that is called Petrosky F score, which is was like given by a professor named Joseph Petrosky. It's basically a score given to companies based on the various criteria, such as their leverage, liquidity, and source of fund, their profitability, and their operating efficiency. And with this code, we come with the like question that come with the answer for the question that should we invest in a stock or not. Like a F score of 9 is considered very nice. Like you should definitely invest. Score like 4 or 5 is like mean kind of thing. Like we could invest or we could not. And if it is like less than 4 and 5, then we should strictly not invest in that company because it is not financially that strong. But I'll just post the link of this notebook in the chat so you can just follow along. So there was no what is one P0 or so uh, like we don't go to negative PE because it's like share price divided by earning per share. And if the earning per share is negative, that means the PE ratio will get negative. And it's like the company is kind of losing money. So we don't go to that scenario uh, because due to some circumstances, it could be that P ratio of a company has got negative, but there are very high chances that it will go above from there because there is a strategy called momentum strategy in which uh, we buy the losing stocks and short the winning stocks. And when this strategy is like back tested, it shows very good results. So that's why we don't deal with zero P, like negative P, because there are very high chances that stock might bounce back. So everybody just open this collab notebook or you can just
But
watch.
there is a PE zero in
Yeah.
the talk.
Yeah, PE zero, like P, like on the bottom, I have taken PE as zero. Like I have not considered as a negative P. I have just taken max of the two functions.
Could you please repeat that?
Like by calculating P in the spreadsheet, I have taken max of the two functions, like two numbers, that is zero and share price divided by earning per share. So if somehow the earning per share gets negative, the maximum of zero and negative is always zero. So that's how it's coming to be zero. Like whenever a P is going negative from the formula, I'm just making it zero.
Okay.
So I'll just tell you the things in the Petrosky score, like the criteria. The first is the net income should be greater than zero. Then the net cash from operating activities should be greater than zero. Like the company should be generating what do we say cash from its operations. It should not be losing money. The next is return on asset that should be greater than like that should be increasing. But return on asset in previous year like in the current year should be greater than the previous year. The next is net cash from operating activities should be greater than the net income. Like suppose like the amount of income it has got, the net cash from the operating activities should be greater than that. It should not be that the whole income is getting converted. Then is the long-term debt of a company should be decreasing. The long-term debt of the previous year should be greater than the long-term debt of current year. Then is the current ratio. The current ratio should be increasing. The current ratio, as we discussed, is the measure of how good is the liquidity. Then this is new shares. Like the company should not be diluting its shares, because if the company is diluting its shares, it means that it needs more money for keeping its operation. So it's a bad signal. Next is the gross margin. The gross margin is basically how much margin the company has on a product, and it should also be increasing. That if uh, if Tata Motors is earning like 5% on a car, they should be earning more than 5% in the next year. Next is asset turnover. That is basically how much turnover they are getting on the asset, and this number should also be increasing over time. So I'll just run this. So for Tata Motors, I gathered all these numbers and made a dictionary of it. Like those who are familiar with Python know what a dictionary is. And for Hero MotoCorp, I have also gathered these numbers. The score for Tata Motors is a 6. That is a very good number. Like not a very good number, but it's a good number that we could buy Tata Motors. And for Hero MotoCorp, it's 4. So it signifies that we should do more research before investing in Hero MotoCorp, because it doesn't seem to be very financially strong. Next, like today event, we have completed it, and tomorrow we will be introducing you with the projects, and the timing for that is 6 p.m. to 7 p.m. So we hope you all will be there. And if anybody has any questions regarding like this thing, they can just unmute and answer.
If you don't have any doubts, you can leave the meet. Right side.